The gentleman that we're about to bring on stage has done something very unique. In less than 2 years, he built a tech platform along with others, don't want to give him all the credit, along with others, that has brought over 3,000 qualified investors together with a variety of back-end content and services for absolutely no charge, and has built a very rich, vibrant community that I've personally participated in my hometown in Denver. I've been to meetups, I've made new friends through this community, and it's an interesting twist because I've joined a few before. So by consequence of that, I thought it would be quite interesting to hear what these guys are doing, how they've built it, where they're going with it. And without further ado, for the very first time, I would like to introduce to you one of the founders of Long Angle, Tad Fallows.
It's groovy, baby.
Thank you, Ben. All right, great to meet you, everybody. Hope you can hear me okay. Let me know if not. My name is Tad Fallows. Now, did you say I have a clicker here, or is the clicker up here? All right. Let me see if that is it. Yes, there we are. So what I thought we'd go over here today, I can give you a quick background on myself and this community, but what I thought would be maybe particularly interesting for this conference is going a little bit deeper into alternative assets. I think a lot of us probably started out as stock and bond kind of investors and then discovered real estate and a lot of the unusual risk-return profiles and cash flow, et cetera, and that sort of thing that comes with it. But especially over the last several years, as I'll explain, has been working on Long Angle. We've gotten a lot deeper there into alternative assets, and I think Ben felt there could be some interesting stuff to share with the community here about what those look like beyond your traditional three asset classes of stocks, bonds, and real estate. So I'll start with introduction myself and kind of how I came to this, and then I'll get into more of the overview on alts, kind of what they are, some more specific examples, and then if it's something that sounds interesting, suggestions for how to successfully invest in that asset class. So my background is, as Ben mentioned, originally I was actually a software entrepreneur. I spent about 10 years bootstrapping a software company for universities and hospitals, got up to about 75 employees, and then sold it to a big Bay Area tech company. And what that meant on a sort of personal level is myself and my co-founder Sriram spent 10 years working and basically making no money, and then on one day got our deferred compensation for our whole careers, and so we're abruptly introduced to a lot of kind of high net worth questions, and especially around the world of alternative assets, although things like estate taxes and various questions like that. And what led us to, because of that, we started this Long Angle community, which, as Ben mentioned, is there's no charge for it, but it started actually just initially with a dozen or so of our friends because we felt like as we had this new set of questions around not spoiling the kids and long-term planning, all the advice was coming from somebody with a product to sell, like a Goldman Sachs, and we wanted to set up a group of people who were in the same situation first person, where nobody was trying to sell each other anything. As I said, initially that was maybe a dozen of us. It turned out that need was a lot more broadly felt, so as people referred their friends, we're up to about 3,000 members now, mostly US, although starting to have more folks outside the US as well. We do a bunch of stuff which I don't need to get into here in terms of, as Ben was saying, meetups, a big online platform where people are discussing various quantitative and qualitative questions, with the only real rule being no solicitation. But relevant to this, one thing that we've started doing over the past couple of years is alternative asset investment opportunities, and really stuff like private equity, private credit, et cetera, I'll get more into here, that have unusual and attractive risk-return profiles, but are fairly difficult to access and especially difficult to underwrite if you don't work in that industry. So we basically try and take advantage of having 3,000 people who have made money in everything from software to oil and gas to roll-ups of HVAC companies, help us underwrite those specific deals with kind of an insider perspective. So that was how I came to alternative assets. And we probably look at 100 deals a month, but we do about one per month, where once we've done all the underwriting and leveraging the people in the community who work in that asset class, for about one a month, if there is one that we like, we will then do a feeder fund where we'll do maybe $10 or $15 million from across the group so that we can negotiate much lower minimums or much lower fees and hit high minimums, and then just share all of those, whatever the negotiated fee breaks are across the community. So with that as background, what is an alternative asset? It's basically anything that's non-public. For the purpose of this discussion, I won't talk about real estate because I think everyone in here knows a lot about real estate, and it's probably the most conventional alternative asset, although in a sense, anything that's not a REIT is an alternative because it's not publicly traded. And in terms of what makes them interesting, why should you bother? Because there's a lot of things you can see in the bottom of this slide that make them more complex than just going and buying an S&P 500 index fund or going and buying a REIT. So the real reasons that one would think about doing it is for diversification and for the potential for alpha or higher risk-adjusted returns. The diversification, probably pretty self-evident. If you look at something like arbitrage strategies or energy trading or catastrophe risk, those things are just not. Everything is a little bit correlated with the overall economy, but they are imperfectly correlated and probably less correlated than something like real estate. A lot of them can be 100% long, short, net neutral. So one is diversification. If you want to have a target similar return of, call it 15%, but you don't want all of your portfolio going up and down with the stock market. The second is that because of their inefficiencies, a number of them do have not just the potential, but a long track record of significantly higher returns than are available in public liquid assets, where your alpha tends to get arbitraged away fairly quickly as large institutional managers come into it. So it's basically two sides of the same coin, where they are hard to access, hard to underwrite, hard to understand, a lot of fraud risk, but when done properly, have the potential for outsized return. As a lot of us are probably familiar with real estate sharing, some of those characteristics, although probably not as extreme as in some cases here. So as I mentioned, there's potential for good returns and non-correlated returns, but the complexities as listed here, is because they're non-public. Really, there is imperfect information. There's not as much liquidity. There's not as much price discovery. There's not as much government regulation. You've got, for any public stock, you have the SEC there, who's going to put anybody in jail who lies on their disclosures. It's much more of a Wild West when you're talking about private equity, so there's a lot more of the buyer having to do their research and being able to separate the good from the bad there. And so you get also just a much bigger dispersion of returns. Again, in the same sense, if you buy 50 stocks at random, you're going to get the average return. If you buy 50 VC deals at random, you're going to lose all of your money. So they need to be more carefully done. They're also just more paperwork, and again, a lot of this is familiar from the real estate world, where you have special tax treatment, but then you're not just getting a 1099 at the end of the year, you get K1s and things like that. So I mentioned this a little bit before, but why do they have the potential to deliver alpha? It's basically because of all the challenges. If you look at something like buying Apple stock, there's 100 analysts who spend all of their time figuring out exactly what Apple is worth, what the discounted cash flow is, what the next quarter is looking like, and report on it. And within 10 seconds of the earnings release, the price is adjusted to what it should be. Because you don't have any of those things in private markets, you can't have the California pension fund flooding the market and bringing it to exactly the current price. If something is only a few $1 million of investable asset class and it's hard to understand who the good sponsors are, they're hard to underwrite, you have to do your own diligence. If done properly, that's what creates the opportunity for having an above market return, basically compensation for the complexity involved in doing this. You also have, the illiquidity creates some of these things like seller dynamics there, where, as a lot of if you're in some, closed-end fund and the apartment building is halfway built and you have to get out, it's not always clear what do you do to get your $100,000 back if you need it instantly, and so you get things like secondary opportunities where you can buy stuff at 70 cents on the dollar and, in return for that illiquidity, capture some of the upside there. So that basically is, I'm not going to read every word here, but the concept of what creates this opportunity for alpha within them. And maybe just to I thought I'd put in a real estate terms here, an example of the difference, between a public version of real estate and a private version of real estate that, a lot of these things should look familiar, where you can buy a REIT and you will have full information, you will have full liquidity, you will have full price discovery, but you're probably not going to get 30% compound returns on that because everyone else can see that. Whereas if you do the research and find some, particular building that needs value add in a particular sub-market that's been marketed poorly, or maybe it's off market, there's the opportunity by doing all that work and, taking the risk there that you're going to get higher return on that. But again, you won't have the liquidity on the back end. You're going to have to hire a broker and you can have to sell on the market's timeline. So that's what that means in real estate context. So to move toward, okay, what are the big categories outside of real estate of alternative assets? I put them basically into 3 buckets here. One is private equity, and equity being ownership in a business. The difference just being that stocks are public equities, and then anything that is not public, generally it's because they're too small to be public, although not in all cases, is a private equity. Whether that is very early stage like venture, whether that's very small like a search fund, or whether it's just sort of in a growth phase or a roll-up strategy. Then you have private credit, which is the perfect analogy to a bond. If bonds, publicly traded bonds are public loans to a company, then private credit, a lot of you may be familiar with, that's a company like Golub, lending to, generally private credit is done to other private companies. The sort of prototypical one will be if some big private equity company like KKR wants to take a company private for $10 billion, they'll put in $5 billion of their own, then they'll go borrow $5 billion from someone else. So it's private lending here. I think, especially today, is a very interesting set of the private assets or alternative asset landscape, because these tend to move at public interest rates, plus a spread. So seeing 12 to 15%, really pretty safe yields today. In some cases, even more than that. So I think the high interest rate environments tend to be very attractive for private credit. And then the third group I'd say is everything else, and there's it's like a fractal. You can keep going down the long tail, and there's always even weirder and more esoteric alternative assets. Like you can buy revenue shares from professional athletes, where you give some 15-year-old in the Dominican Republic $100,000, and then you get 5% of his lifetime earnings if he goes pro. You can get into whiskey aging or power grid arbitrage. Without getting too far down there, just suffice to say there's a big catch-all bucket, and litigation finance, no matter how far you define it, there's always going to be some other niche ones, but the 2 big groups are probably private equity broadly defined, and private credit. I just put this up here. I did an analysis of the deals that we have syndicated through the community, and again, these are not sort of what I have selected personally. These are the ones that I and my partner thought seemed interesting overall, and then we took that big group and put together deal teams of individuals within the community who sort of work in and know each of those individual asset classes to narrow them down to the best in class. But then of the it's about 30 funds or 30 different deals we've done, how that breaks down overall. So you can see about half of that is in one of these purple shades in private equity. Not as much in the blue, the private credit there. I think that's mostly because they've got very good risk-adjusted returns, but you're never going to make a 40% IRR on private credit the way you might on a good private equity deal. I think a lot of people are just excited about the very high returns, but again, you can make a safe 12, in some cases even 20% in private credit today. What I have there in gray, in green, the secondary shares, those are really any different asset class where you're buying not from the kind of original sponsor, but you're buying from something that's already in progress. So you're probably, again, familiar with this from real estate secondaries, but venture capital is another asset class where those are very common, where if I've maybe put $1 million into a VC fund 10 years ago, and these companies are still growing, I still haven't got my money back, and I just need my money back now, there's a big market in buying, these growth stage pre-IPO, the more famous ones like SpaceX, but where there's probably bigger discounts is in little companies that are doing maybe $10 million or $20 million a year now, and you can buy a big portfolio of those because they're still pretty far from exit, and the initial investor just wants their liquidity, they want to get out. It becomes a little tricky because it's very hard to put a market value on those. You can buy secondary in private equity, or really anything you can imagine you can buy off somebody else, generally with a pretty good discount, call it 30 to 50% discount below net asset value on average. And then other various things like commodities or crypto, things like that. Actually, one of the more interesting commodities plays is around whiskey aging, and I can give an example of that in a second, where it's had extremely good risk-adjusted returns. So just to talk about private equity for a couple more slides here, a couple reasons why you might want to do it. One is just that only a minority of companies out there are public companies. So this is looking at all the companies in the US, not including like, barbershops or dry cleaners, but of decent size, over say 100 million of revenue. The significant majority of those are privately held, and as you look at the number of public companies out there, it's actually declined by about 50% over the last several decades, as there's a lot of disadvantages to being public in terms of the cost and effort and liability of being public, and the private equity industry has grown and competed for a lot of those, so they never end up IPOing. So if you actually want full diversity and full exposure to the broader market, you kind of have to own private equity, or else you're not owning a lot of companies. So that's one reason, is just diversity. The other reason, potentially more compelling, because you could say, hey, the S&P 500 is already 500 companies, I don't need more diversity than that, is they tend to just be much cheaper and trade at lower multiples. You know, the whole reason you IPO is to get a public market multiple. But if you're buying stuff in the private markets, you can see obviously it depends year to year, but on average you're paying about 10 times for an enterprise value there, enterprise being the market cap plus debt, so about 10 times, whereas public markets today are more than 20 times. And so just to buy $1 of income, you know, you can choose to pay $10 in the private market or $20 in the public market. Now, of course, it's not as easy as an instant double, because if you turn around and sell it tomorrow, you're still going to get that same 10 times. But as you know from real estate, again, if you buy at a lower cap rate or lower earnings yield, you're kind of building up more retained earnings there. And a lot of these will ultimately exit to the public market or exit to a strategic acquirer and get basically a multiple premium. So the general thought being that you buy it relatively cheap, your good private equity operators can drive value and improve these companies, and then they have an exit where they get a multiple bump there. So you get sort of several bites at the apple. And then you end up, historically, there have been stronger returns in private than public equity. You know, if public is averaging 10%, private probably pushing closer to 20% a year. Then, you know, within private equity, as I mentioned, there's just a lot of flavors of this. Not to talk about, you know, every one, but just to maybe give a couple of examples. Venture, you're probably familiar with. I would say anybody who's interested in dabbling in private equity, do not start in venture. That is like the deep end. It's the longest timelines. It's the hardest to figure out the valuation. It's the hardest to evaluate a sponsor, because their track records don't start until, you know, 10 or 15 years out till they realize them. But I think middle and, you know, large cap private equity probably looks a lot like public markets, but mid cap, where they're buying, you know, $100 million, a couple $100 million kind of companies, they are, you know, lower multiples. They have the opportunity for greater gains, but are still big enough to not have some of the risks of kind of the venture or the micro cap. One other asset class I'll get into a little bit is search funds, which are really micro. It's hard to get access to, but the returns there have typically been the 30% plus range. So if you can get access, it's very interesting. And that can either be like roll-ups of somebody who's buying a bunch of dental firms or putting them together, or search funds where you basically back some smart MBA grad from Harvard or Stanford, and he goes and buys a company, and then, you know, he turns it from a $1 million company into a $10 million company, which sounds simplistic, but actually has been a very proven asset class over the past 30 or so years. So that's general kind of thoughts on private equity there. Looking at private credit, you know, this is, as I mentioned, it's basically just loans to private companies. The stereotypical or prototypical one being a private equity firm. You know, they don't do any of these purchases 100% equity. You know, much like real estate, they juice their returns by putting debt on it. Typically about, you know, 50-50 debt to equity, not super aggressive, but it does increase their returns there. As I said, you'll typically see on the sort of lower risk end of the range here today, probably 10 to 12% interest rates. If you get into some nichier ones, you may be able to get that up to 15%, or maybe get some equity warrants as part of it, you know, which obviously leads to better total returns there. And I think this can be, it is not, while it's often a private equity model, there's not just one end market. You can lend to a whole bunch of different kinds of companies, you know, as you can see here, from software to IT services to automobiles, et cetera. And then just, you know, if you think about loans to private companies, whether they're public or private, or, you know, bonds here, there's this sort of sweet spot right now in terms of these middle market loans, which is to companies basically less than $100 million. And what's interesting is the difference is not just interest rates as you think about loans, but also really information and covenants, where different size companies have different amounts of leverage in negotiating with their lenders. And you get basically, you know, just much more transparency because you have more leverage, and you know, more transparency and more kind of influence on the covenants and more control on these lower middle market ones. Again, I would not advocate for most of these asset classes, but especially this, for people to go make their individual private credit loans. But the idea of the way you do this is through, there's a number of very large proven operators with tens of billions of dollars under management. So again, you get a diversified portfolio as well. It's not like you take a single private credit position here. So that's kind of private credit at a high level. Hedge funds, I put this in here because this often comes up. In general, I am, maybe a personal bias here, but I think I speak for probably the 3,000 people in the community when I say that it's not a very attractive asset class. The idea being that you want to, they're designed, as the name says, to hedge. You hedge your upside and your downside. That works in theory, and I think a lot of endowments and pension plans like these, and it fits well into a modern portfolio theory framework. But if you actually just look over the significant frame of time now at what the returns have been and what the fees have been, you end up getting below market returns for above market fees. So if you are passionate about volatility and really want to mute the volatility and want to get fancier than stocks and bonds and money market accounts, they may have a role in the portfolio. But I think if generically, people, if you're interested in going into alternative assets or private markets in general, I would certainly do one of the other ones before hedge funds. They tend not to really be a retail-oriented product. They are more, again, like a pension fund that's trying to match their assets with their liabilities and worried about, people living too long or immediate drawdowns. Then hedge funds can play that role there, but less for people like you and me. Commodities here, I think everybody knows what a commodity is. This slide is probably more interesting because a commodity does not just mean, I'm going to buy some gold and think it'll hold value or buy a barrel of oil. You can do those things. I think that largely just becomes a bet on the price of those products. There's some, though, that have more of a actual expected return. And so I think this is just an interesting example and probably a good microcosm of why private market deals in general can be interesting and can deliver returns because of sort of niche dynamics here. So just to talk about whiskey aging is kind of one that I've spent a lot of time diving into and gives examples of how these weird market dynamics lead to returns. So basically what you find is that newly distilled whiskey, if you have the right relationships and can buy it, is call it $1,000 a barrel. And 5-year-old whiskey is $3,000 a barrel. And this has been a pretty consistent curve for a number of decades. And so if you just buy it at one and sell it for 3 times the amount 5 years later, obviously that's a great return. And so the obvious question would be, well, why? Why would anybody do this, or is it going to be a bubble? As far as I understand it, the general dynamic behind this is that somebody wants to start a bougie new whiskey brand. You can't sell brand new whiskey in your bougie brand. You need 5 or 10-year-old whiskey, but you're not going to start your company 5 or 10 years from now. So you basically need to buy it from somebody else who's been sitting on it for the last 5 years, and that's where that private investor comes in. There's a little bit of the bigger brands, either having excess inventory or not enough inventory, need to trend this market. But a lot of it is that the people who really want to be building these businesses need the already aged product today. Something else that's just kind of interesting about this is, as we've done a couple deals in here, I was super skeptical. I felt like this seemed just sort of too good to be true / a bunch of marketing fluff. But one of the things I found actually reasonably compelling about it was you can worry about a bubble or not, but basically there is no, if you look 5 years out, you know exactly how much inventory there will be 5 years out. It doesn't matter if everybody in the world builds a new distillery today. You can't possibly create 5-year-old whiskey in 2 years. And so you have perfect foresight into what the supply will be of 5-year-old whiskey 5 years from now. And then it only becomes a demand question. And do you think, there could be some exogenous risk like France and Japan put on whiskey tariffs, but sort of in a realistic world of fairly constant demand, you actually have very long foresight into what the supply-demand balance will look like. So this is just kind of an interesting example of one where you can see very real returns. And I think the other thing I like about this as an illustration is I think the good version of alternative asset or private market deals are not black box. I think that's one of the things I don't like about hedge funds is you don't really understand what's happening. The market here, dynamics are very clear, and the reason you make a profit is very clear. And I think in general, it's a sign of a good investment is you understand, how it's working. So just in terms of a handful of other kind of interesting alternative asset plays. I can kind of take questions or go deeper into a few more case studies like that whiskey one, but just sort of a few other ones to touch on quickly here. GP stakes are interesting. It's a version of private equity, but what it means is you are actually buying ownership in the private equity management company itself. So you're becoming an owner of Carlyle or KKR or Apollo or Blackstone. And what's interesting about those is those guys basically make money three ways. They make money on their management fees, they make money on their profit share, and then they also make money because they co-invest alongside their vehicles. And these tend to trade at just pretty conservative valuations. You're basically only paying for the management fee stream, and then you get the rest of it as a bonus. So you've historically had, it's an interesting combination of equity-like appreciation, but then a solid, real estate or bond-like cash flow along the way. A second interesting one is these search funds. I mentioned that a little bit before, but that's probably on the other extreme of private equity, and just kind of a very interesting one where what it is, as I mentioned, is you'll have an MBA student. What they say is, rather than going and working at Goldman Sachs, I want to spend 2 years looking for a company to buy. I want you to give me $100,000 to pay my bills for the next 2 years. And in return, you get a right of first refusal to I'll either pay you your money back when I find a company and fund it, or you get a right of first refusal to, treat that as a capital contribution and then write $1 million check into my acquisition here. And about 2/3 of the time, they find something to buy. And what you've historically seen for those is, the asset class started around 1980 out of Stanford Business School. And Stanford does this report every year. They look at every search fund deal out there, which is not a lot. It's, call it a couple $100 million a year. But they've seen every year, every vintage, between about 30 and 35% IRR returns on those deals, because you get a combination of a couple things. You find some mom and pop shop that's making $1 million or $2 million a year. They buy them at a low multiple, call it 4 or 5 times profit. Then they double the profit, and they get a multiple arbitrage because they do a better job cleaning up and selling it at 10 times. You have twice as much profit selling at twice the returns. You get a 4 times, without doing any heroics or magic, you get kind of a 4 times return there. The trick there is it's tiny, and so it's just hard to kind of get in touch with these people if you're not yourself a professor at Harvard or Stanford. So we spent a lot of time trying to figure out how to get in touch with those people. And then energy is, one other very interesting asset class I would say today, where you've seen, kind of most of the operators the last 5 years been putting up in the 40s, 50s, or 60s IRR. Obviously, there's a little bit special going on there with oil prices having been good lately, but basically a whole bunch of your institutional capital has flooded out of that market because endowments and pension plans have ESG concerns and just don't want to be putting money into upstream. And then at the same time, the technology, the geological risk has gone down quite a bit, and there's much more certainty about what you're going to get when you drill and frack a well than there was, 30 years ago. And so you get it becomes a much less risky and recently very high returns. A lot of these things are trading about 2 times cash flow. So anyway, that's kind of a quick overview that I wanted to share here. Key considerations for anybody who is interested in exploring this a little bit more, I'd say by far that first one is, if you can't get beyond that, then doesn't make sense to go further. But you really need to actually be able to underwrite these and get access to the best-in-class operators. Just the nature of the lack of information, lack of regulatory oversight. Again, is that a randomly selected alternative asset is not going to be a particularly good deal, and there is just a lot of, fraud or other problems like that. And so you need the ability to either personally, there's one asset class you understand, or what we tried to do here was leverage the expertise of other people we trusted to get expertise and access to a number of them. I've listed a few of the other things here, which again are just kind of a price of doing business in a high return asset class. Things like the taxes being more complex, less liquidity, longer timelines, more complex, some use of leverage. Again, if you're interested in real estate and being here, a lot of this probably won't scare you because a lot of these factors are shared in common with real estate. And then probably just the last slide share here, and then kind of take any questions. To this point around the importance of sponsor selection, I think this slide does a good job of illustrating it. You can see on the left there, what those dark bars represent is the difference between a top quartile and a bottom quartile fund in each of those asset classes. And you can see effectively it's just very hard to outperform in a public market because they are so efficient, everyone's competing on the same information. The best and the worst operators are really pretty similar. Whereas you get into private markets, and the best operators are unbelievable, returning 25% a year, or the top quartile, that's not the very best, but the top quartile. Whereas the bottom quartile ones are destroying value. At best, they're returning capital. At worst, they're actually losing capital. So I think that just reinforces the point that it can be an excellent asset class, but if done correctly. Let me just pause there for a second. I have a couple other slides I can share, but I want to see, since it's a little bit of a smaller group here, happy to take any questions. Yes.
I'm a member, and I've been with you guys for about 18 months, so thank you. You guys are amazing, and you do a great job.
Well, thank you.
We just had our first micro Salt Lake meetup. It was micro, but anyway. So one of the things that has held me back from investing is I'm accredited but not qualified, and so maybe you could talk through like the difference
Yep.
between those classes and why so many of the offerings that you guys have move more into that qualified.
Excellent question. So the question, to repeat for those who didn't heard, is how does one just qualify as an investor in some of these? I think a lot of us have heard the term accredited investor, and there's basically 3 levels, and I'll just talk about them for a second and the reason those exist. So there's accredited investor, which means from a net worth perspective, you have more than $1 million of investable assets. There's also some income options. There's a qualified client, which means you have more than 2.2 million. And there's a qualified purchaser, which means you have more than 5 million. The differences on them are basically, if you are not a qualified client, or put differently, if a fund wants to make carry or accept a profit share in their deals, they are only allowed to accept people with 2.2 million or above. They have to be qualified clients in order to invest in a fund that charges a profit share. And this is an SEC regulation of basically trying to protect less sophisticated investors, for lack of a better term. Now the difference, qualified purchaser is one level higher. That's a $5 million minimum. And the difference for that is if you are a private fund, you can choose to follow, to sort of do a public SEC registration and put together extremely complicated and impenetrable and expensive document of sort of an offering, or you can rely on an exemption saying we're not doing this as an offering. And there's 2 exemptions. One of the qualified purchaser exemption, which is I'm only going to take money from people with more than $5 million. I am then allowed to accept money from 1,000 investors. If I rely on the other, I think they're C1 versus C7. If you rely on the one where you accept qualified or accredited investors, then you as a sponsor can only accept 99 accredited investors. And so the reason that most of these deals, so the question was basically, hey, a lot of the deals that have gone through long angle, she's found attractive, but hasn't been qualified to invest in. It's because the underlying sponsor, so it's not coming from us, but it's like the private equity fund is saying, hey, we want to have 600 investors in this deal. If we accept anyone with less than $5 million, then that sort of poisons the whole well, and we can only have 99 investors in total in our fund. So that's the reason for that limitation. So I hope that wasn't sort of too nerdy technical there, but that's the background on it. There's a couple of things we're looking at doing there. One is if you create a pooled vehicle that invests in 3 different funds, it then doesn't have the same treatment. So we haven't done that to date, but we're looking at, okay, if there's maybe 3 similar search funds, we can invest in all 3, and then we could open it up to accredited investors, not only qualified purchasers. Any other questions? Yeah, I can hear you.
If we have to pick a top 3 classes of alternative assets,
Yeah.
how do we search or how do we invest and create a portfolio of 3 to 5 or 3 asset classes?
Yeah, so the question is, okay, if you were to pick, say, a top 3, maybe what would they be and how would you look at them? I think part of it changes over time. Like I would have said 2 or 3 years ago, real estate is like the top alternative asset class. And, I personally went all in. I said, hey, if I can borrow money at 2.5%, I'm going to borrow $10 million and, put it all into assets that I know inflation is coming. I don't feel that way today. I think, as we all know, with interest rates and cap rates where they are, I don't think real estate is the top 3 today. I'm sure that will change again. So I'll talk about what I think are the answers today, but it will be different in the future. I do think private credit is very interesting Not, again, that you're going to double your money overnight, but if you can get a safe 15%, I'm going to take a safe 15% all day long. And so I think that is a good one to look at. And your other half of your question was how to go about researching them. But first, I'll answer that first question, which to look at. So I would say probably private credit. And then, within kind of I think secondary shares would probably be a second one, because they also have there's a lot of sort of dislocated assets out there where people want liquidity and markets are not really providing the liquidity. Like if you, at least I would say even today, IPOs are not going on very much, and so people who have been in venture capital for a long time want a way to get out. But I'd say also in real estate, real estate secondary shares. So generically, I think today's market dynamics are well set up for secondaries. And again, some of the funds we're in, they're typically buying about 50% discount to the underlying asset value, or at least the marked value. So I think that's good. And then, I guess within the world of private equity, it's a pretty good setup for a lot of them. But I would say in general, I'd probably look at your small cap stuff today. That is either like a search fund or a small cap roll up. Because what's interesting about those is they get this multiple arbitrage where the smallest companies sell at 4 times profit and larger companies sell at 8 times profit. So even if they are not improving the businesses, just by sort of combining them together, you get some free tailwind that way. So I'd look at those 3. In terms of how you approach them, I think your private credit is probably going to be the easiest. Well, for any of these, you could go, through a group like ours where we syndicate collectively, and I'd be happy to talk with anybody. If you look online at Long Angle, you're welcome to join there. Again, we don't charge any fees. That's one option. But if you want to sort of do stuff directly, of course, it depends on the size of your check. If you're writing, $10 million checks, you can probably get anything you want to. I think most of these require at least $1 million checks. If you're talking about 50,000, you probably have to kind of, go through some syndicating kind of group. I'd say with the exception of private credit, there are a number of publicly traded private credit funds that yield about 12%. So the big companies you're probably familiar with, like Golub, I think KKR has. Golub I think of as probably the best operator, but there's a number of these. So if you Google private credit exchange traded funds, I think you'll find one there. The secondaries, you're not, almost by definition, you're not gonna find that publicly. So I think this kind of microcap private equity and the secondaries are going to be less publicly available things, and you need to either, again, just kind of search for good sponsors if you're able to write a large check and underwrite yourself, or kind of go through a group to access those. Or potentially, if you work with a RIA or wealth manager, they may have access themselves and be able to help you with the underwriting. That would just totally depend on the wealth manager you work with, but a lot of them will see that as part of their value add.
One more question I have is, where do we go to search which are the top alternate assets?
So the question was, how do you figure out who is the top manager there? I think it's as much art as science, but I will say generically what, maybe a more useful answer than that is the factors that we look at when we're evaluating any deal. We look at 6 factors there. One is the track record of the sponsor. And so just, what is the length of time they've been in business and what do their returns look like? If you're going with a first fund sponsor, you may be able to you should get fee concessions because you're just taking more risk there. If you have somebody in like their second or third fund, you're going to de-risk it there. I would look at just what's the historical or the target IRR. Higher is better. Look at the tax treatment of it. Look at the idiosyncratic risk. Look at the correlation. But in terms of I guess the track record, you also if you're going to write big enough check, you should be able to interview the investment committee there and have basically. I'm sure you can Google online a due diligence questionnaire, ask them to fill it out, and then have phone calls where you interview them. Again, a lot of this, that's part of the reason I try and do it with other people, is if I'm saying I'm going to write you a $500,000 check, nobody worth their time is going to take my call. Whereas if I'm going to write a $15 million check, then I'm going to get the main guy on the line. He'll kind of answer my questions. But I think, and also the better ones, if anybody's not forthcoming, if their IR department, I've learned the hard way, ever says like, hey, you're asking too many questions, to me that's a big red flag that I should not work with them. I think the good ones are very happy to have well-educated LPs. Yes?
I guess the first thing I wanted to do is thank you because I feel like your content and your voice is a wider aperture than a lot of this conference. And as someone that's 95% in public markets and 5% in alternatives, it's truly an alternative for me. Seeing this in a balanced way is very helpful and useful for me, so I appreciate the voice.
Well, thank you.
Yeah. The second piece that's the actual question is I feel like the SEC is in the process of raising the requirements for
Yep.
investors, both on assets and income. Do you feel like that will create big changes in these markets, or do you feel like the majority of folks that are involved will already exceed the reset asset and income thresholds?
Yeah, so the question here is, do I have any perspective on the SEC's increasing regulations, or what will do these markets? I would say you are absolutely right that they are increasing the level of scrutiny. I think this is sort of an evergreen thing where you could probably have made that statement anytime in the last, since the Great Depression, that the SEC is kind of upping their game. And like my wife is an exec at a bank, and it's the same thing there. Every year the regulations get tougher and they have more and more regulatory standards. So I don't think this is sort of, while that is the direction of travel, it's not a kind of step change on it. I know, just because even as syndicating, now that we're over $150 million, we have to be SEC registered, and there is an enormous amount of work there, and like they're requiring more audits, and that have cost. To your question of, will this mean that fewer people can participate? I don't think so, because I think this $5 million qualified purchaser limit that you mentioned before is already, most of the deals effectively are there. I have not heard anything about raising the limit above $5 million. I think a lot of that kind of would be below 5 million, or just things that make life a little bit more cumbersome for the sponsors. But the sponsors, if they want to stay in business, are going to have to just deal with more audits than they used to, or more compliance than they used to. So I don't think it will really, my perspective is it won't really change access to it. I don't think these markets are suddenly going to become sort of like the public markets in the sense of now being totally liquid and perfect information and that sort of thing. I think just the cost of maintaining a publicly traded company is sort of too high, that a lot of these asset classes would destroy their returns if they kind of had to comply with that. One thing I wanted to mention, though, is on this $5 million limit, for those who are interested in this, that is actually a gross investable assets, not net investable assets. So theoretically, if you owned a $5 million apartment building and you had $4 million of debt on it and $1 million of equity, you would actually fall within the qualified purchaser category. So, for those who are interested, it's just worth being aware that it is a gross threshold there. I see we are pretty much at the end of time here. I really appreciate everybody. I hope that this was interesting and informative to at least some of you, and happy to chat with anybody offline afterward. But thanks very much for your time here.
It's groovy, baby.
Awesome. Thank you so much. Another round of applause for Tad. Yeah, thank you, Tad.